With us, Jahangir Aziz, Head of Emerging Market Asia Economic Research at JPMorgan, joining in on the show. Jahangir, hi, good morning and good evening to you. Good to have you on the show as always. Jahangir, just going by how the Indian bond markets are moving, it seems like they're well adjusting already to a rate cut by the MPC.
Look, I mean, the rate cut was, at least in our view, was always in the cards. We've been calling for it for quite some time. And it was even before the quarterly growth number came out, because there were already signs that the economy was slowing. Inflation was reasonably benign, and the RBI had given us enough signals that it was willing to ease. So the slowdown in growth was something that they would use to cut rates. So I think that was always in the cards. The question is, are we at the beginning of a easing cycle, or this, or maybe one more rate cut and that's it? So I think the debate should be how much more rather than whether or not we'll have a rate cut this week.
Jahangir, I just wanted to also throw your attention to what's going on with crude oil prices. That really seems to be in our favor as well. There are lots of comments with respect to what OPEC is saying, extending the supply cuts. But the fact of the matter is that with crude oil prices declining, that is only a positive for the Indian economy. How exactly do you see this overall correlation shaping up for us?
Look, I mean, low oil prices has always been positive for the Indian economy, but I wouldn't really term this as a net benefit. The question is, why is oil prices coming down? And the oil prices are coming down despite, reasonably tight supplies, because there's a considerable amount of concern over global growth. And even though we might think ourselves to be a closed economy, which is not the case, and we will be vulnerable to a global slowdown. We have been vulnerable to a global slowdown and will continue to be so. So I think the overall global economy, or the slowdown in the global economy that's driving the low oil prices on the net, is unlikely to benefit India. We will, of course, benefit from the low oil prices, but we will be giving up quite a bit from the slowdown in the global economy.
Also wanted to understand, last evening, Jahangir, the RBI has tweaked the NBFC exposure norms, and now they're saying that they're restricting lenders' exposure to single NBFCs to 15% of the eligible capital base. And they're also saying that, more stringent exposure limits may be considered in respect of certain NBFCs. Would you say much the need of the hour?
Look, I mean, the NBFC problem is something that may have started as a liquidity problem, but I think it's very quickly morphing into a solvency issue, at least in some NBFCs. I think, like the non-performing loans problem of Indian banking system, many of us had pointed this out right at the beginning of this government's previous tenure, so back in 2014. The government took its own time to come up with a solution. By the time the solution was put in place, the NPL problems had increased considerably. My fear is that, this moving slowly on the NBFC problem is probably one area where, the rise of the NBFC, or the spread of the NBFC liquidity problem turning into solvency issue is something that, could happen. I think the government needs to resolve it much sooner rather, not much sooner, but sooner rather than later. And tentative steps towards resolving this issue is unlikely to be good for the economy.
Also, Jahangir, on the subject of liquidity, wanted to understand what is it that you're hoping to hear from the MPC? Because, the last two rate cuts, the transmission hasn't happened. And would you say that's going to be imperative more than the rate cut? What are you expecting to hear from them on liquidity measures?
Look, I mean, the fact that there hasn't been a transmission, that's been a problem even with the previous two rate cuts. And, the question is, if the question is what should the RBI do versus what the RBI will do, then I think the answer is that the RBI needs to essentially resolve the NBFC problem rather than it's more important than going with a rate cut. You asked the question what the RBI will do, and therefore my answer was that the RBI will be cutting rates not just once, but probably even more than once. But clearly the imperative is resolving the liquidity side of the NBFC problem. And I'm not exactly sure what the RBI has in mind, given by the steps that have taken so far. It is unlikely, or it doesn't seem that the RBI is looking for or the government is looking for a comprehensive solution. Now, at the end of the day, the NBFC problem is a problem that will require government policy changes more than the RBI. So I think it's not just a question of RBI. I think the government also needs to play a big role in the resolution of this problem.
All right, Jahangir, appreciate you taking the time out and joining in with your perspective on all things macro.